Kitco News special coverage of Bitcoin 2022 is brought to you by Coin Payments, crypto payments made easy.
We're talking about the ever-changing macroeconomic landscape and Bitcoin with Lyn Alden, founder of Lyn Alden Investment Strategy. Welcome to the show in person. Great to see you finally in person. I've spoken to you for many, many months, almost 2 years now. First time I've meeting you in person. Welcome. Good to see you.
Great to meet you too.
Yeah.
Definitely.
We're here at the Bitcoin Miami conference. Before we talk about the economy, what are some of the things you've learned so far, just by networking, talking to people, some of the highlights of the show that you could share with our audience?
I think the main thing is how diverse it is, in the sense that there's, for example, very different stages.
Yeah.
Right? So some people hate one stage and love another stage.
Right.
You have kind of the stage for the suits.
Yeah.
You have the stage for like the techies. You have stage for like, people focusing on human rights. Everybody kind of has their own angle about Bitcoin that interests them. And you can come from totally different walks of life and find it interesting. So I think that's the thing I always learn from these conferences is, it has kind of that, the media likes to paint it as kind of a tech bro sort of environment. When you actually dig into it, there are all these kind of like micro cultures inside of Bitcoin. I find that always interesting to see in person.
What's the sentiment on the overall crypto market right now in the conference? Just based on what you've seen, based on the conversations you've had, is there anybody who's significantly bearish on Bitcoin?
I mean, there are always people bearish, but I think obviously you're self-selecting here, right? This is like a Bitcoin festival. People coming from around the world so you generally you have a pretty strong sample of bulls here. You could say long-term bulls. So I don't think you're going to get the best sentiment here.
Yeah. Well, it would be interesting to see, I guess, attendance drop. I guess that would be a sentiment indicator.
Yeah.
But I think attendance is rather strong.
But that's the thing. It more than doubled from last year.
That's right.
Even though price has been choppy sideways.
That's right.
So I think actually that's a positive indicator.
I wonder if that's because of other projects besides Bitcoin. I mean, you've got the rise of NFTs from last year. You've got a huge amount of other DeFi projects that have been onboarded. Do you think that capital is flowing into the crypto sector that's not entirely related to Bitcoin? I mean, I'm making a differentiation here between Bitcoin and the rest of cryptos.
We have seen some broadening out, but that kind of goes in cycles. So, for example, you had a broadening out back in the 2017 period as well during that bull market. Generally, bull markets kind of have these, the bull market in altcoins usually peaks after the bull market in Bitcoin.
Yeah. And
so even though now we're in a kind of consolidation, some of that more enthusiasm in the altcoin space was actually more recent than some of the enthusiasm in the Bitcoin space. So I think that contributes to the overall thing. Yeah. You have a lot of VC capital going into crypto. You have big name athletes in on it. But I also think the Bitcoin ecosystem is kind of its own thing, is also growing over time. Okay. So they're actually kind of in some ways separating, right? So you have kind of very different demographics in some way between, say, Bitcoin only versus the broad crypto space.
Okay, let's talk about the overall macro landscape first before we dive a little deeper into Bitcoin. Now, the Fed has raised interest rates since last we spoke. I believe it was several months ago. They've raised their first rate hike of the year, projected to raise several more times. I've been hearing a range of estimates as to how many times they're actually going to raise. Realistically, Lyn, how far can they go in terms of rate hikes?
I think until they break something. I'd be surprised. I think, so going back, I've been on the inflation side for a few years now.
That's right.
And funny thing is, I'm surprised by the speed with the inflation we got. I mean, part of it, when you add a war to the mix that was not, necessarily anticipated by me or a lot of other people, or at least not at this time frame or in this scale, that certainly adds inflationary force to it. And so the Fed being more hawkish than expected. But if you look at, say, where inflation is and where rates are, in some ways they're the most dovish they've ever been.
That's right.
The biggest disconnect between rates and inflation since 1951. And so I think their clear mandate is to try to tighten. And the hard part for them is that they have a horrible track record of tightening into a decelerating economy, right? So if they tighten while PMIs are rising, they generally have a better shot of getting some decent gains there. Whereas if they're trying to tighten into a slowing economy, that's kind of the recipe for disaster. That's kind of when you ran into it in late 2018. And so they're kind of running in that same environment now, but of course inflation is much higher. So I don't know exactly how far they're going to get, but I'm going to take the under on whatever consensus is for how far they're going to get.
I'm going to come back to inflation and rate hikes, but slowing economy, really, what indicators are you looking at? Again, just I'm looking at Canada, for example, where I'm from. I know Canada and the U.S. aren't, exactly the same, but they share similarities in their broader outlook. But anyway, the Canadian economy is seeing the lowest unemployment level ever on record. So I wonder where you're seeing the slowdown.
So basically, everything else besides employment is the funny thing. So that's kind of a lagging indicator.
I see.
And so, for example, if we look at purchasing managers indices, that's probably the cleanest one to look at because it directly measures rate of change.
Yeah.
And you see that peaked back in 2021. It's kind of rolling over, and you're still in positive growth territory, but you're decelerating at a pretty rapid rate.
Right.
So that's number one. Number two is if you look at consumer sentiment, like surveys, like for example, Michigan consumer sentiment, it's at almost like lows not seen since 2009. Right, so you obviously had a drop in March 2020. Then you had a bounce when you had all the stimulus and opening back up. But then that sentiment rolled over to new lows for this cycle, despite the fact that employment is unemployment is super low. And one thing to keep in mind is that even though workers are finally getting wages and unemployment is pretty low, inflation's higher than the average wage increase. So part of why it's so troubling is that on one hand you have an overheating economy. But on the other hand, people are not really feeling it.
Yeah.
And so I think that we're starting to see signs of decelerating.
You brought up PMI. So the slowing PMI, I wonder how much of that is due to just logistical problems coming out of Europe, really, from the war.
I mean, I think that's contributing, but that was already happening before the war.
Okay.
Right? So now, I mean, everything complicates it. So lockdowns in China complicate it. Europe complicates it.
Right.
All of that is a shock to the system. We were actually already rolling over back in 2021. And so, Bitcoin has a tendency to kind of see these things coming because it's kind of liquidity. ARC rolled over. A lot of these things kind of rolled over, and you start to see PMI roll over. And so we are starting to see across the board, there's actually a lot of slowing indicators, despite the fact that at the very moment, certain other indicators still look hot.
I think the word slowing is kind of scary for a lot of people's minds, but we got to put things into perspective here because last year in 2021, because of the base effect of 2020, growth was just astronomical. So it was bound to slow down at some point. So how bad or normal is this slowdown? One could argue this is a normalization process. One could also argue we're slowing down into a recession. So what's the scale you're looking at?
So that's a really good point, because if you look at over the prior expansion period, right? So a decade-long expansion, you had like 3 mini cycles in there. You had rising, declining PMIs roughly on 3-year periods. And so you had these slowdowns that did not necessarily result in recessions. This one's a little trickier because we do also have yield curves inverted for a period of time. Some percentage of the yield curve is inverted. So there are kind of more recession indicators this time, but we're still in that period where we're dipping. It's unclear if it's going to manifest an actual recession or if we're going to kind of dip and then have a rising period out of this. If you look at Atlanta Fed GDP now forecast, last I looked, they were looking at something like 1% real growth annualized for this quarter. So there are a lot of things that look slow. And I think as you look out maybe 6 months, the question is this kind of a valley, higher growth thing? I don't think we have enough data to say for sure yet, but it's not looking fantastic at the moment. Okay.
Well, do you think rate hikes are going to push us into a recession?
Well, so the only thing that rate hikes can really control here, because all the inflation we're seeing is two main things. One is there's all the fiscal stimulus, so it's more money in the system. And number two, you have supply side inflation, so commodity shortages, supply chain problems, add a war to the mix. And so the Fed, they can't print oil, they can't print copper, they can't fix supply chains. So all that they can really do is try to reduce demand, which risks putting you into a recession. Right? It's kind of that whole game of they want to slow down demand, maybe soften it, get a dip, but they don't really want to cause a recession. But it's almost like you're kind of stuck between a rock and a hard place here. So I'm not optimistic that they're going to have a soft landing, as they like to call it.
I saw Janet Yellen make a presentation in Montreal a couple of years back, and she said that recessions are caused by 2 things: fiscal imbalances and the Fed. So that was my question, whether or not the Fed is going to cause the next recession. So let's talk about what the Fed is doing right now. Let's go back to what you mentioned earlier about rate hikes. I've heard economists argue that what they're doing anyway isn't going to be enough to fight inflation. We've got inflation at 7.9 was the last reading. It's CPI is coming out soon, so who knows what the next month's going to be. What is a level that's enough to fight inflation? Keep in mind, in the early 80s, we had double-digit inflation, and the Fed funds rate was also at double digits. So do we need to see interest rates at the same level of inflation, percentage-wise, before we see inflation come down? Is that what we need?
So that could certainly give a shock to the system, a deflationary shock. But I think the inflationary pressures are deeper than that. I don't think the Fed's tools really, especially given how high debt levels are, that they really have the tools to properly fight inflation. I think it's more of a fiscal problem, and it's more of just how we've structured supply chains. I think that this is only going to be resolved by improving supply chains, improving commodity capex, kind of the real world changes, and those are not quick changes. But one thing I caution people on is that for example, I'm staying in the inflationary camp. Before the war, I was expecting maybe like a localized top in inflation. So we've obviously added fuel to that fire. But I don't really expect inflation necessarily to be a straight line.
Yeah.
I think that we're going to be in a very inflationary decade compared to the prior decade at least. But even I'm still anticipating eventually slowdowns in inflation. Maybe the Fed gets a handle it for a period of time, but then they end up having to loosen because they go too far, you have a recession, and then they cut, and then you get another round of inflation.
That's right.
So in the 70s, you saw multiple rounds of inflation. In the 40s, you saw multiple rounds of inflation. These things tend to come in bursts.
That's interesting. You said that it's a fiscal issue, not so much a monetary issue in itself. I'm wondering if that's could be resolved by the government, Congress, rather than the Fed. Because suppose the Fed were to reduce the growth of M2 money supply. Are you saying that wouldn't be sufficient? You also need congressional support to somehow rein back spending, I guess?
Partially, because it depends on where that M2 growth is coming from. So, for example, in the 70s, it mostly came from bank lending.
Yeah.
Right? Banks would lend more money into existence because you had the demographics boom, right? So you had all the baby boomers starting to buy homes. Because of the demographic demand for commodities, and you had the whole the M2 expansion from loans, that was a contributor. If you go back to the 40s,
yes,
it wasn't that banks were lending; it was that the government was spending a lot of fiscal deficits, into existence and having it monetized.
Right.
And so that's the M2 growth we've seen over the past 2 years. A lot of it is from that fiscal impulse, and they're rather rate insensitive. I mean, if they want to pass a fiscal bill, they're not looking and saying, well, what are our treasury rates at? They're just kind of passing it, right? So it really comes down to watching political gridlock, right? Because that's the environment that they're increasingly in, is this kind of gridlocked environment. And so it really does come down to Congress, but even if I think you had a perfect Congress, bringing this down immediately without causing, kind of a recession is challenging. It's kind of pick one, inflation or recession, and only in the longer run can you say, okay, how can we have the economy allocate its resources better? How can we get more commodities? How can we get more infrastructure? How can we diversify our supply chains? And that only comes with time.
I want to touch on debt and interest rates. You study the history of debt in the United States. Correct me if I'm wrong, Lyn, but according to your research, I believe you stated that in World War II was the last time we saw huge amounts of national debt. How does our current debt level compare on a percentage of GDP basis compared to that of World War II?
Yeah, it's comparable to the peak in World War II. It's the only other time we were this high. Obviously, there are some foreign countries now that are higher, such as Japan and Italy, countries like that. But the United States is kind of touching the top that it was at in the 40s. And that's also the environment where when they had super high inflation, which was caused by fiscal spending related to the war, they still held interest rates low.
It's interesting because we don't have a world war right now, right?
We don't know, but we have, for example, supply chain issues. You have kind of the same sort of effect on the war. I was actually asked a question on the podcast once, like if you didn't know COVID happened, and you're looking at the current economic indicators and stuff, what do you think's happening? I would say it looks like a war.
It looks like question. I think I'm going to steal that.
It looks like it looks like wartime finance.
That's right.
And that's something that because when debt levels are that high and you have rising populism and you have rising, all sorts of issues like that, recessions become crises, right? What should be a normal recession instead gets this gigantic response, right? Because they're so levered they can't afford a recession. And that's when you get those more inflationary, fiscal heavy, wartime finance looking things. And then we went and added an actual war to the mix now, right? So even though the United States is not at war with Russia, there's all these proxy wars happening now. There's financial wars happening, there's supply chain wars, there's commodity wars, and of course there's the actual kinetic war. So I would say now we've actually entered the fray of really being at war.
Wow. Back then in World War II, in the 40s, what was the interest rate level?
Well, the interest rate, they kept the short end of the curve at almost zero, something like, I think 0.3%. And then they capped the long end of the curve at 2.5%.
Right.
So you had an artificial positive shallow yield curve.
Okay.
But inflation would go up to 19%, then come back down to negative 3%, then go up to 12%.
Yeah.
And just kind of bounce around. It averaged like 6% for the decade, even though interest rates averaged 0 to 2.5% because they held the whole yield curve below the inflation rate, which is actually what we're starting to see in Japan. They're starting to do formal yield curve control. And then you see Europe and the Fed, they're not doing formal yield curve control, but they're purposely behind the curve of inflation. They're letting kind of some of this debt inflate away, and then they're slowly now kind of waking up to raising rates.
I would imagine, I mean, maybe not officially, but I would imagine the Treasury might be having conversations with the Fed and telling them to, slow down on raising interest rates, because at current debt levels, it becomes rather unaffordable to have interest rates at a historical 3, 4, 5%, wouldn't it?
Well, that's the rock and the hard place, because on one hand, one of the worst things for re-election is high inflation and low consumer sentiment.
That's right.
Which is what the Biden administration is facing, which is what Congress is facing. So on one hand, you want them to control inflation, but it's like you can't always have what you want. If you have this high of a debt level, and if you have these structural problems with your supply chains and your commodities and your economy, and so you're kind of stuck between a rock and a hard place. And I think the Minsky moment comes when the Fed eventually breaks something with their tightening, and yet inflation's still here.
Right. Okay. So two-part question now. What is your outlook on inflation? And given your outlook on inflation, what markets do you like?
So until about a month ago, my answer would have been that I see kind of inflation maybe sort of peaking out around here, at least locally, despite the fact that I still had a long-term inflationary bias. I was kind of setting expectations to maybe start stabilizing. The war certainly added a lot of complexity to the mix. So now, part of an inflationary outlook has to be like, what is Putin going to do? What is Europe going to do, right? So there's this huge amount of variance. I think I'm going to stick to my view that we're going to have these pullback periods, either due to central banks trying to tighten and kind of putting us in a recession, or just, supply, oil opens up again, oil price kind of stabilizes, you kind of get a period of stabilization in inflation. So I think inflation's here to stay longer term. I just don't have a high conviction about, say, any 6-month period, because that's kind of a geopolitical question.
Right.
But I'm bullish on Latin America for the most part. I'm bullish on gold. I'm bullish on Bitcoin. Basically that kind of more commodity-oriented space, as well as the value stock space. So, for example, in this kind of recent market turbulence, you've seen healthcare stocks hold up pretty well. You've seen energy pipelines hold up pretty well. They're less tied to the energy price. And so I like assets like that. Real assets and value assets.
Yeah, the real assets thesis makes sense to me. Just on Latin America, I know a lot of Latin debt, or most of it, is based on where it's denominated in U.S. dollars. So if you're bullish on Latin, are you implicitly bearish on the U.S. dollar because that would erode away some of their interest expenses?
In a way, yes. One of the things that we're seeing now, so for example, the dollar index is going up. It's very strong.
Right.
But there's very a lack of breadth to it. So for example, it's more about that the euro and the yen are being very weak right now.
Yes.
So for example, if you compare the dollar to the yuan's actually been strengthening relative to the dollar over the past year or so. There's a huge divergence between dollar yuan versus dollar index. And the same thing, if you look over, say, year to date, the Brazilian real's doing great as far as emerging market currencies go. So really, the dollar's not been particularly strong versus many emerging market currencies. It's mostly against those big two, developed markets. And so I'm kind of neutral on the dollar indexes overall, mostly because Europe has an acute energy crisis. Japan also is doing formal yield curve control, and so those are very currency negative. But I'm not particularly bullish on the dollar as it relates to emerging markets, which is why I'm somewhat favorable towards a number of emerging markets.
Okay, let's talk about the petrodollar system. You mentioned to me offline. That's one of the topics of your presentation at this conference. So tell us about how the system is changing.
Well, I think the war certainly added some catalyst to that, right? So my view since 2020 is that we're going to start to see more diversification of reserves and payment systems.
Right.
Partially it's from technology, partially it's from just geopolitical realities. And the Russia war on Ukraine accelerated that because Russia has their reserves frozen. Now every country in the world knows that sovereign bonds are not the best store of value if you want to have your country be as independent as possible. So I think we're going to see increased interest in gold, increased interest in reserve diversification. We've seen Brazil, for example, they're increasing their yuan weighting, which makes sense because it's their largest trading partner.
Yeah.
So they've gone from virtually zero exposure to the yuan.
Right.
They've increased it to something like 5%, from a low base.
Right.
They plan on continuing to increase that somewhat. I think we're going to see a spreading out of this and kind of a less focus on the dollar-centric system, even though network effects of that size don't just unwind overnight.
We've got a few minutes left, so we have to talk about Bitcoin because we are at a crypto conference. Very quickly, your price outlook on Bitcoin and just your thesis behind why you think Bitcoin is going to the price you think it is.
So in the next 6 months, very uncertain, right? Because historically, if you look at rising and falling PMI environments,
Yes.
most of Bitcoin's bull run activity occurs during rising PMI environments.
Yes.
So you have favorable liquidity, you have risk-on behavior, Bitcoin tends to do very well.
Yes.
In declining PMI environments, that's when Bitcoin has historically suffered.
Right.
But what's new is that Bitcoin's never really encountered a stagflationary environment in major developed markets.
Yes.
Right. So that's a whole new variable. I certainly would rather own Bitcoin than some of these companies that have tons of supply chain exposure, margin pressure, things like that.
Yes.
So we'll see if it starts trading like a commodity,
Yes.
like a monetary commodity. We've actually seen some favorable decoupling from Bitcoin compared to, say, ARK stocks, right? So Bitcoin's less down than, say, many of the ARK stocks were, right? So that's kind of been a favorable decoupling, even though it's not been exactly bullish for Bitcoin. So I'm kind of neutral over on the next 6 months. I would expect volatility. Longer term, I think the fundamental picture looks great. The development that's happening on it, the use case for it couldn't be more clear, especially, you have people fleeing from Ukraine and, ones that are self-custodying Bitcoin, they have some of the easiest time in terms of bringing wealth with them with the least hassle.
And the Lightning Network, very quickly, is something that you've worked on and were researched, and that's contributing to the on-ramp and adoption of Bitcoin as a form of payment, right?
I think that's an under reported story, right? So we're seeing, for example, Bitcoin circling back to its original kind of intentions being used for payments.
Yeah.
And Lightning is a layer on top of Bitcoin that makes it way faster.
Correct.
And it's still, varying degrees of decentralized. Right. Maybe not as decentralized as the base layer, but it's some of your trade-off. And you get super fast payments. And now we had an announcement, for example, for stable coins that can be natively issued on Lightning potentially. So a lot of development in that space that I think is really interesting for the payment industry and could disrupt some of the major players.
Excellent. Lyn, honored to finally meet you in person in Miami, of all places. I look forward to speaking with you again and delve even deeper on Bitcoin. But thank you for your thoughts today.
Happy to.
All right. And thank you for watching Kitco News. I'm David Lin.
Kitco News, special coverage of Bitcoin 2022, is brought to you by Coin Payments, crypto payments made easy.